Welcome to Finance Frontier, your go-to podcast for all things money, markets, and monumental events that shaped our financial world. I'm your host, Rachel Adams, and today we're diving into the 5 biggest financial scandals in history. Joining me is none other than Dr. Michael Carter, a seasoned finance expert and professor with over 20 years of experience studying corporate governance and financial fraud. Welcome, Dr. Carter.
Thank you, Rachel. It's a pleasure to be here and to share insights about these fascinating and sometimes shocking events.
Let's get right into it. Financial scandals often shake not just companies, but entire economies. What's your take on why these scandals happen, Dr. Carter?
Great question, Rachel. At their core, financial scandals often stem from greed, poor oversight, and the temptation to cut corners. Add to that weak regulations or complicit parties, and you have the perfect recipe for disaster.
Let's start with a name everyone's heard of, Enron. What went so wrong there?
Enron was once celebrated as one of America's most innovative companies, but behind the scenes they were hiding billions of dollars in debt through accounting loopholes and fake entities. Executives inflated profits to boost stock prices and their personal wealth.
And then the house of cards fell.
Exactly. When the fraud came to light, Enron filed for bankruptcy in 2001. It wiped out $74 billion in shareholder value and cost employees their pensions. The scandal also led to the collapse of Arthur Andersen, one of the largest auditing firms at the time.
A tragic example of what unchecked greed can do. What lesson does this teach us?
Transparency and ethical corporate governance are non-negotiable. No company is too big to fail.
Let's move on to the infamous Bernie Madoff. How did he pull off the largest Ponzi scheme in history?
Madoff exploited his reputation as a Wall Street insider to lure investors into a fake investment operation. He promised steady returns, but instead of generating profits, he used money from new investors to pay off old ones.
And it all unraveled during the 2008 financial crisis, right?
Exactly. When the markets crashed, investors wanted to withdraw their funds, and Madoff couldn't keep up. The total losses? Around $65 billion.
Wow. What should investors learn from this?
If an investment sounds too good to be true, it probably is. Always ask questions and verify legitimacy.
Speaking of 2008, let's talk about the financial crisis. This wasn't just one scandal, was it?
No, it was systemic failure. Banks issued risky subprime mortgages and bundled them into complex securities. Investors believed these were safe, but when homeowners defaulted, the entire system collapsed.
And the result?
Lehman Brothers collapsed, global markets tanked, and millions lost their homes, jobs, and savings. Governments had to bail out banks to prevent total economic collapse.
Hard to imagine the scale of that. How do we prevent another crisis like this?
Stronger regulations, better oversight, and ensuring financial institutions don't take excessive risks are crucial.
Next up is the LIBOR scandal. For those unfamiliar, can you explain LIBOR and what happened?
LIBOR, or the London Interbank Offered Rate, is a key interest rate used globally to set rates for loans, mortgages, and more. In the LIBOR scandal, banks like Barclays manipulated this rate for profit.
That sounds like a massive breach of trust.
It was. The manipulation affected everything from personal loans to global markets. Billions in fines followed, but the damage to consumer confidence was immense.
A reminder that trust is the cornerstone of financial systems, isn't it?
Absolutely.
Lastly, let's talk about Wirecard. What made this Europe's biggest financial fraud?
Wirecard was a German fintech giant that claimed to be highly profitable, but in reality, it fabricated $2 billion on its balance sheet through fake accounts in the Philippines.
And how did they get away with it for so long?
A combination of weak audits, regulatory lapses, and aggressive tactics to silence critics. When the fraud was exposed, Wirecard collapsed, shaking Europe's financial landscape.
A modern-day cautionary tale. What's the key takeaway here?
Effective auditing and independent oversight are critical. No company should escape scrutiny.
Thank you, Dr. Carter, for shedding light on these monumental scandals. Each of these stories serves as a powerful reminder of what can go wrong when ethics and accountability are ignored.
My pleasure, Rachel. It's always important to learn from history to avoid repeating it.
And to our listeners, thank you for tuning in to Finance Frontier. If you found this episode insightful, be sure to subscribe, leave a review, and share it with your friends. Until next time, stay informed and stay financially smart.